If you own a rental property, you should have some sort of financial plan for the property. Mortgage, taxes, insurance, and HOA dues are the obvious monthly expenses, but do you have any financial planning beyond those? At minimum, you should have some sort of reserves or savings account for the property. This account should contain at least 2 to 3 months worth of monthly expenses, plus an additional 2 to 3,000 on top. Having this level of reserves would cover most vacancy periods and unit turn costs. It would also cover most repair costs during the tenancy if any maintenance issues were to arise. But what about your capital expenditures? Do you account for the major mechanical systems that are far more costly to repair, such as the HVAC system or the roof? Most investors do not. Many investors hold the belief that the property can be sold before incurring these replacement costs, but in this market, that's just not the case. If the house has an old roof or AC system, these are expensive repairs that will result in the vast majority of buyers passing on the property or submitting a lowball offer. Next to consider is record keeping. There are considerable tax advantages to owning rental properties, but are you properly tracking all expenses? One thing I did to simplify organization was creating an email account used solely for my rental property. All invoices for recurring services are sent to that email. Any repair costs or materials purchased throughout the year also go to that email. This makes it very easy at the end of the year when preparing to file taxes. This also makes it easier to reevaluate your financial plan. Do you have enough money in reserves, or are you saving too much? Another thing I did was to remove the escrow from my property. On a monthly basis, we only pay the mortgage, and the rest of the rental income goes into a high yield savings account. When the tax and insurance bills come due, pay them from that account. This allows us to be more in tune with our expenses and keep more of our money in our account because we do not have to worry about the escrow shortages or overages. Although this strategy would not be recommended for everyone, you've probably heard me say it before. You should have a plan. Know your month-to-month and year-to-year expenses and plan accordingly. Plan your exit strategy for the property. While owning long-term rentals is generally passive, you still need to have a plan in place and reevaluate that plan when necessary. For example, if you buy a brand new house, you should not have any minor capital expenditures like painting or flooring for at least 5 to 7 years. And you shouldn't have any major ones for at least 10 to 12 years. But an older house is more likely to experience unexpected repair costs, so plan accordingly. Failing to plan for expenses and capital expenditures can leave you in a strained financial situation if the repair costs hit you at the wrong time and you don't have the budget for it. Additionally, not handling repairs in a timely manner can potentially get you in hot water when it comes to landlord-tenant laws if the property remains uninhabitable. So make sure you create a financial plan that incorporates your rental expenses and works with your financial situation and lifestyle.